Hey there, and welcome to my channel, The Paper Bag Investor. Today I want to be looking at a number of high growth companies and asking the question, what is mindshare? And how have these companies captured the mindshare of their markets that they're in? What is mindshare? How and why does it work? And ultimately stay tuned to the end as I want to answer how you can identify in other companies, upcoming companies, how they are capturing the mind share of the consumer base, and with that you can make huge winning investments for your portfolio over time. So stay tuned to the end as I kind of break down my thoughts on that. And before I go any further, I just want to be absolutely clear, not a personal financial advisor. I'm just a guy with a paper bag on his head who loves investing and thinking about the future. If you love investing, you love thinking about the future, I encourage you, hit that subscribe button down below, follow along with my channel as it grows, and become a better investor with me. So let's get into it. The title here is Best Growth Stocks, Companies That Have and Are Capturing the Mind Share. Okay, we're going to get into what that means. And I'm going to play a clip actually from David Lee. He has a great YouTube channel, and he did an interview with LMND's Daniel Schreiber. LMND's a growth company that I'm interested in, an insurance company out of the US. So let's play that clip.
One of our early investors was Google. And a while ago, we had an interesting conversation with Eric Schmidt. And he was chatting about growing fast and capturing market share quickly. And he said that Google, in the early days, they missed out on 3 markets. I think, I'm not actually sure what it was. I've got a feeling it may have been China, South Korea, and maybe Russia or Ukraine or one of the Eastern European countries, I think maybe. And he said, you know, Daniel, to this day, in 2 out of those 3 markets, Google is nothing, which is amazing. It's this idea that the market may be huge, so market share isn't a problem, but mind share is an issue. And part of the reason that we at Lemonade are moving fast is I do believe that there is some wet cement where there's a placeholder for the 21st century incarnation of insurance. What does it look like? The Google of kind of thing. And if you write your name in the cement while it's wet, it endures for a long time. If you miss that opportunity and somebody else writes their name, it's a lot of hard work to try and change that.
Okay, so from that clip, we can ask the question, what is mindshare? It's high growth companies that capture the marketplace as rapidly as possible, and they have an advantage over others that come after them just because they are there first and they've captured the market. They've really captured the minds and the hearts of the consumer base. It's really what we're talking about when companies are able to do that. What does it capture the mind share really mean? Like, what does that look like for companies? I think it means they're companies that really are making growth the highest priority. Grow at all costs, really. I mean, maybe not all costs. You can't go bankrupt as a company. You have to stay alive. But during that growth period, they're just pedal to the metal, growth at all costs, whatever it takes. It means to grab as much as the market as possible, as quickly as possible, right? This example again from Lemonade, their letter to the co-founders in there, and actually did another video, a sort of intro video on Lemonade a week or 2 ago, and I discussed this letter in there, but they say they're trying to grab, they explicitly say in this letter that they want to grab as much of the market as possible, as quickly as possible, even at the expense of sort of perfect products right now, perfect insurance products, even the most sort of profitable they can be on every product right now, because they feel it's more important to just aggressively capture the market, capture the hearts and minds, capture the mind share of the consumer base that's out there. Okay, so here's some examples of companies that I think are products that have done this already. This is not an exhaustive list, but just a few examples, obviously. So Amazon's one, Google Search, of course, Google's YouTube, Google Photos, even Google Drive you could throw in there, Google Photos, Google Drive, Connect. Netflix could be in there, Facebook, Spotify as a music streaming service. Obviously, all these companies have competitors, but they're really leading the force in these areas. Tesla in the electrical vehicle market. Why does the mind share stick so strongly? Why does this idea that if you just capture the market first and as aggressively as possible, then why does that have such a huge advantage over the companies that come after you? And there's 4 reasons I kind of identified here. 4 reasons. Number 1, you have the first mover advantage. Okay, quick example of this would be Netflix. Any company now could come and start a streaming service, right? And others are doing so. But Netflix has the advantage, just as a first mover, they have the advantage that they are bringing in revenue and funds in a new area in online streaming before anyone else does, and they're able to actually take that revenue and funds and reinvest it into either buying more content for their platform and or making content for their platform. And so that you have that first move advantage where you already have the ball rolling and you continue to make the best content or buy the best content for your streaming service, which if someone else is just starting up and they don't have that same capital, it takes a lot of risk and capital for someone else to really join in the fight or be a true competitor. Another example is Tesla versus NIO or even other electric vehicle makers. I heard rumors that Tesla, their Model Y went on sale in China just the other day, and within the first day there was 100,000 orders or reservations made for the Model Y, and also rumors supposedly that people were canceling their orders for their NIO cars in China. And it kind of makes sense from a consumer because Tesla was the first mover and they've kind of passed the hump that people know Tesla is going to be around 10, 20 years from now. For like it's almost 100% guaranteed that as a consumer buying a big product like a car, even if the cars were very comparable, exactly the same price, they might lean to getting a Tesla because they know if anything goes wrong 10 years from now, there's still going to be maintenance for the car that's available. There's still going to be a good charging infrastructure network that's available. A smaller company like NIO, I think NIO is going to survive and be around, but there's a little more consumer risk for the companies that are following and for the consumers buying those products that maybe they're going to go bankrupt, maybe they won't pan out correctly. So it drives people to pick that first mover company, that's capturing the market first and aggressively. Okay, so that's that first mover advantage. Another reason why is you gain, just by growing first and rapidly, you gain as a company intangible learnings and refinements from experience. And these are sometimes difficult to identify. And the typical sort of Wall Street analyst doesn't always really talk about some of these things or notice these little details, but they make huge differences to the actual business. An example I want to give you guys is Amazon's dominance and refinements in logistics and shipping. So Amazon is just a great example of they saw that online retail is going to be huge and they just grew aggressively as possible, keeping their margins as thin as possible so they can just keep their prices are as attractive as possible so they can just keep pushing their market and grabbing the mind share. But also one thing, they learned in doing all that is they got better and better at their logistics and their shipping. And now, any company really, again, Amazon's not SpaceX. They're not landing rockets or doing some kind of crazy technology. They're just shipping products and have a website for retail. It's not really that complicated, but it is complicated in the really fine details of being extremely efficient with their logistics and their shipping and their customer service. These little details that they've ironed out and are making better and better because they've pushed so hard to gain the market share. While another company, if they wanted to start an online, Walmart wants to start an online retail service, or they do have that, but if they want to make that even bigger, more like an Amazon competitor, it's difficult for them to compete because Amazon can just have such competitive prices because their logistics are so good, and they've only gained that knowledge and that skill by pushing out as fast as possible. Okay. Number third reason here is consumer complacency in switching. So after consumers get used to a new product in a new area, a new field, and then competitors coming along behind them, even if those competitor products may even be slightly better, it's difficult. It's difficult for them to bother switching. It's just a hassle to figure out a new system, switch things over. So this really could apply to any of those companies that I listed. And the fourth reason I identified was what I call network effects, which is really where when a network of users use a product or service, as the number of users in that network grows, the value to the network to every user grows exponentially. And this is really only starting to occur. These kind of network effects, they just didn't really exist before the internet occurred, and now we have this sort of digital economy that we're in. Example of this would be Facebook. So example, if you're the only person on Facebook, Facebook's completely useless. If there's more and more people in your network, in your social circle of friends and family that are on Facebook, which they are, then it becomes more and more useful. And it's very, very difficult to overthrow them. You can make a Google Plus or whatever Google called it, new social media service that's just like Facebook, but it's nearly impossible to actually overthrow Facebook because everyone you know is already on there, and the new people that are coming, the sort of challenging companies that are coming behind you trying to make the same service, it's basically useless because none of your friends are already on there. You already have your service, you already have your Facebook and your profile and everyone you know on Facebook. So again, it's that network effect, and this is an extremely powerful effect that we really didn't see until we landed in the digital age, the internet age. So you're probably wondering, guy with the paper bag on head, how can I apply this and do better with my investments myself? What's the bottom line? How does it affect you and your investments? Okay, so really what you need to do is look at companies in new technology arenas that are focused on aggressive growth, really prioritizing that, number one, and are executing towards it. Even if these companies aren't even necessarily bottom line, GAAP profitable at that time, they still can be excellent investments because they're just pushing to capture the mind share of the market. Okay, an example again of Lemonade. We'll just look at Lemonade as a more up and coming digital insurance company. Some of those 4 points identified. To me, they're the first mover in a digital 21st century insurance company. Legacy companies are trying to make apps and little, fancier websites to add on to everything else that functions in their sort of whole ecosystem. But Lemonade's the first one I've seen sort of envisioned from the ground up. It's like a new build of a building from the foundation up. They made it all in the digital realm, focused for streamlined digital. So they're the first mover in that area. They have, and they're still kind of pretty young, very young company in that area. Still lots of growth ahead of them. Their intangible learnings that they could be capturing by pushing out as fast as possible. One thing I really wonder is a big one for insurance and insurance underwriting and appropriately underwriting risk, how to capture as much data digitally as possible. This is a big question I'm still answering with Lemonade as a Lemonade investor and someone who really has a tiny bit of their portfolio in Lemonade. If I really can answer this question though about how do they have a data advantage just by doing everything completely digitally better than anyone else? If they do, and I'm thinking they probably do. I'm still researching this though. I'm going to do more videos on this. So if this is capturing your interest, make sure you subscribe so you see those future videos. But I'm thinking they probably do. But if they do, I think they could just be a huge winner over time. Just as long as they can effectively learn to capture data digitally, much more than other insurance companies could in their traditional insurance methods of, just going in and getting your life insurance and filling out a paper form. If they can capture more data digitally and harness that, I think Lemonade could be massive winner over time. And I'm still learning still researching that. So again, subscribe if that interests you. Okay, but also their consumer complacency and switching. It is nice because it's super easy to switch to Lemonade. Once they have the market though, if another 21st century digital insurance company comes behind them, it might be different. People might be more hesitant to either bother switching. And network effects. With them, there's no peer-to-peer networks effect like that, like a Facebook network would have, but there could be a network effect that if they just capture as many users as possible, and if they can get more data out of each user that can tell them whether this person's a higher or lower risk of their apartment getting broken into or their home burning down, then they can more on a more granular basis assess the risks and assess how much they should charge for their insurance policies, which is really the crux of what winning big at insurance is all about. And I'm still looking into that. I find it very fascinating as I've read some things, seen some interviews with their co-founders where they're talking about different ways that they're capturing, sometimes like they're suggesting 100 times more data points than a traditional insurance company would. And to me, that's what I'm still researching. Again, I'll have some videos on that coming up. Anyways, I'd love to hear your thoughts though. Let me know in the comments down below what you thought of all this. Are there other companies that you see that are capturing their mindshare, that are early on in their growth story, that you think just could be fit exactly what we're talking about here, that are pedal to the metal, growing and capturing the mindshare, capturing the hearts and minds of their consumer base? If there are, please let us all know in the comments down below what you think. If you like this, you got value out of it, please subscribe. Hit that thumbs up, smash the like button, so they say, share this with somebody else who loves investing, is interested in this as well. And you can find me on Twitter at paperbaginvest as well if you're on Twitter and you're into that. So thank you so much for watching. Have a great day. Cheers.